Hey Dave, how you doing today?
I'm doing great, Nick. How are you?
All things considered, I am doing very well, which for our listeners might be a little bit strange just because of the week we've had, right?
Yeah. Markets went from being extremely bullish and everything rolling right along for the year to all of a sudden being very pessimistic. And you know, over the course of the last couple of weeks, the S&P 500 is down about 6.5% from its peak. Still very positive for the year, but
Yeah.
definitely a mood change. And when that happens, I like to monitor the press requests that we get for comments, right? And we're
Right.
seeing things like this last Monday was really ugly in the markets,
Yeah.
and I think at one point the S&P was down like 5% during the day,
Hmm.
and we were getting like, is this the Monday crash of 1987 all over again? And and it really drove home like how quick a investors' minds change, and B, how the news media and financial press doesn't help, like throws
Right.
fuel on the fire, right?
Yeah.
Like another advisor was like, when you start throwing around 1987, people sit up and pay attention, right?
Yeah.
um
Well,
and
it's just remarkable to me because it's just a great reminder of how irrational the market can be. I mean, you think about all year, all we had talked about is
yeah,
rate cuts. When's the Fed going to cut rates? They really need to
yeah.
start. And now that they're like at that point that they're talking about probably doing it in September, like the market's going crazy, the opposite direction
Right,
you'd think.
well, yeah. So the first half of the year, it was like, oh, we don't want the news to be too good. We don't want the news to be too good.
Right?
On Friday, the unemployment report comes in a tenth of a percent higher than the previous month, and all of a sudden, it's gloom and doom.
Yeah.
So anyway, that's really not the point for today. Our point is to talk about like overarching, like how do you
Yeah.
deal with volatility in general in retirement? Because the volatility is a fact of life.
Right. It's always going to be
Yeah.
there. It's a part
It's
of it, and you have to learn how to
yeah,
deal with it. Right.
yeah. As one of our favorite behavioral finance writers likes to point out, Daniel Crosby, corrections in the market, which is a drop of 10% or more from the recent high, are as regular as your birthday. They average about
Yeah.
one per year since World War II.
Right.
So,
Yeah.
so it's not like, on the one hand, the market averages 10% over the long haul. On the other hand, every year there's a drop of 10% somewhere in there. That's a lot. That's basically saying things are good in the long run, but in the short run, oh my gosh, anything can happen. And you just have to deal with it. So,
Lost you for a second there.
yeah, it keeps blinking in and out. I'm not sure what to do about it. I don't know if it keeps recording while I do that.
I don't think so. Well, hard to say.
Okay, what do you want to do?
I assume that it's going to keep happening,
Let
and it's
me let
probably
me
going to make things
try
chunky.
let me try one thing here.
Okay.
Hold on, I'm going to
If you want.
disappear for a minute.
Okay.
Am I there?
Yep.
Let's see if that keeps it more stable.
Okay. If not, we can just do it a different day. It's not the end of
Okay,
the world.
so let Hammond know the time to cut there.
Yeah, down 330. We'll call it.
So so we have to accept that this kind of volatility is going to happen. On the one hand, you have a 10% long-term average in the markets. On the other hand, in every given year, we can expect a 10% downside move.
Right.
That's a lot of ups and downs to deal with. And the real trick to being a resilient investor over the long haul is not making emotional responses
Right.
during those kinds of turbulence, right? And that's really
Which
hard to
is
do.
Yeah, I was going to say super easy for us to say and
Right.
tell you to do, but in practice, it's very
Yeah.
different.
Yeah.
And especially, I always talk about too, like when you're young and you're not planning on using this money anytime soon. Like that's one different set of
Hmm.
emotions. When you are about to retire or recently retired, you have a whole different set of emotions with like your attachment
Right.
to your long-term investments, right?
Yeah. Yeah. And again, as behavioral finance folks like to point out, we have a very old brain dealing with very new problems.
Right.
And I just read a great book on this topic called "The Hour Between Wolf and Dog," and
Okay.
I highly recommend it if you're into like the nerdy science of why your brain reacts the way it does. But it's, our adrenal glands and all of our hormones are built around fight and flight kind of
Right.
circumstances, right? And so
Right.
what maybe that, we kind of act like, oh, like when we're talking to clients and we're saying, don't react emotionally, it kind of comes across as it's all in your head, and it's not all in your head. It's like built
Right.
into like the way your body deals with scary
Yeah.
situations.
Yeah.
Even though the markets are not the same as holding your hand over a fire, or being chased by a lion across the savannah. The physiological response is very similar.
Right. Yeah.
Yeah, we need to recognize that it's real.
For sure, yeah, and
Yeah,
and that's what and going back to my previous point about like when you were young, like it's not the same. So don't be surprised by the
yeah,
heightened emotion of it, and
yeah,
know that that's going to happen because the more you prepare yourself for that before it
yeah,
happens, the better off you're going to be not making those emotional
yeah.
decisions. Just realizing that it can and will happen to you, right?
Right, right. So how do you cope? What can we do about this?
Yeah,
So, I like to look at some of the things that can be used that psychologists use to deal with general anxiety. I think are very applicable. Some of the cognitive behavioral therapy techniques that apply to general anxiety really apply to market anxiety as a whole.
sure, absolutely,
Um, so, things to consider. In general, cognitive distancing, trying to like put some space between your emotional reaction and the reality of the markets.
right,
Okay. And easier said than done, as you pointed out a few minutes ago, but start by just remembering that when you read headlines in the news and you see things come across about the market and in the economy, remember that the news is in the business of sensationalizing everything, first of
right,
all, and try to strip out the value judgments from the statements.
mm-hmm.
When you're thinking about what's going on, don't say, "Oh my gosh, this is a terrible day for the markets." Don't don't immediately like catastrophize everything in your mind if you can help it. Step away from that and try to ask yourself, if you believe in the long run of the markets, does what's happening today really matter at all?
Right.
You
Yeah, I
know,
think that's great advice. And to your point about being a long-term investor, right? If you think about retirement, you think about retirement investing, usually we're talking 20 to 30 years. And so we have that long-term nature, right? And what's happening in the short term, while it affects that and while it affects us emotionally, it doesn't really change the long term outlook. And everything that you see going around you in the short term, as far as like people selling, people doing different things, they're
yeah,
all is going to back to one of our favorite Morgan Housel. They're playing a different game than you, right?
right,
So
yeah,
like distance
yeah,
yourself from what you see in the market and people making moves or selling things or telling or getting out of the market altogether. They're doing something completely different than what you're doing, and trying to distance yourself and not worry about what other people are doing
right,
is really helpful in terms of like thinking through how this is going to affect me and what I need to be doing.
right, right, and yeah, just recognize that you're a long term investor, not a short term trader.
Right.
Start with that,
Exactly.
and the news should take a different flavor based on that. The next thing on the list is reality testing. Okay, so you're faced with this scary situation. The market's down 5% today, intraday. What do I do? Well, one of my favorite things with clients is to go back to the financial plan and show them that one bad day, even a really bad day in the markets, doesn't usually change anything that we would have to do.
Right. Yeah.
And sure, it may impact decisions like, do we take money out today to make a down payment on a car? Well, we can talk about that. But does it mean you can't buy that car? Probably not.
Right.
I mean,
Yeah.
probably
Absolutely.
doesn't impact that decision. Said that
Yeah,
wrong.
well, and it's such a good point because when we created these plans, we assumed that there was going to be bad
Right,
days, right?
right,
And we
right,
built that into it. And so when we pull
right.
up the plan and say, "Here, look, nothing's really
Well,
changed," like we have run scenarios where this happened,
yeah.
and probably
Well,
worse than what's happening, and you've been fine, which is why we
right.
do the work that we do.
We don't just test bad days. We test bad months, bad years, bad bear markets. One of
Right.
our one of our most simple ways of looking at retirement and timing is, what if this was October 2007 and the
Right.
market's at its peak right before a severe, long prolonged downturn? What happens?
Hmm.
And so from a reality testing standpoint, that's part of financial planning.
Right.
And just on an intraday or intra-week kind of basis, also remember, if you've got a diversified portfolio, you're not holding all of your money in the S&P 500 or the
Yeah.
Nasdaq, right? And
Right.
and that I really it always kind of is a moment when I have client meetings during times like this, because they'll come into the meeting thinking they'll have some number in their mind, right?
Yeah.
I've heard it's been lousy, and then we look at the reports and they're like, oh, huh, it's not that bad. Well, remember, 40% of your money's in bonds, and
Right.
now it's it's easy to lose sight of that. And so reality testing and decatastrophizing, remembering that your portfolio is probably not the same as whatever the index that you're hearing is
Yeah.
suffering.
Right. Well, it's interesting too because most of the media, right, talks about what happened that day or whatever they
Hmm.
can sensationalize, right? So they take like the
Right.
worst period of time from the very top to the bottom, but
Right.
they don't like expand that at all. And so we have this, if we're not looking at what's actually happening or what's been happening over longer periods of time, we just kind of have that frame of reference of this is like worst case scenario of what's happened.
Right.
And you can even pointing out to what's happened recently versus where we're at year to date, right, is a great example of that.
Yeah. Yeah.
But I think also, we're having the opposite conversation that we've had with people for the last couple of years in that the reason why we were diversified, the reason why we have bonds in a lot of portfolios is because of times like this, right?
Right.
And it didn't feel great when the S&P 500 was taking off.
And everything
But
was
all of a
positive.
sudden,
Right.
yeah, right. All of a sudden, we're like,
Yeah.
oh, that's why we did this, right?
Right. 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 And yeah, it's easy to lose sight of that, but the journalists that are telling you how lousy things are don't have any idea how you're actually invested.
Right.
You know.
Well, and they're incentivized to get you to click on their article or read what
Right.
they're telling you. So, of course,
Right.
it's going to be the worst news possible.
Right. Right. So also to if you think through what is going on, usually the results over the course of a little space of time aren't as catastrophic either. And I think just, let's think through Friday's headline, from the last couple of weeks, was that unemployment has finally started to show some signs of rising, as we expected it would, because interest rates
Right.
have been higher. Sure, that's a negative thing. But
Yeah.
what happens if we continue to see weakening in the economy? The Fed will lower interest rates. That
Hmm.
will then ameliorate some of that damage. It doesn't mean we don't have economic risk, but
Right.
it's not like everything's going to zero because the unemployment rate spiked by 1/10%.
Yeah.
All of a sudden companies are worthless, and the
Right.
long-term results of the economy are. So think through. Economics is rarely ever a zero-sum game, particularly if you're
Right.
diversified.
Right.
If things happen in the world, we've talked about this in our episode on like global headline risk, right? If
Mm-hmm.
something weird happens in the world that we didn't expect, some companies may lose money because of that, but other companies may benefit from it, whether
For sure.
it's global conflict or just a change in technologies. There's winners and there's losers.
Yeah.
You don't want to be 100% invested in buggy whip manufacturers when Henry Ford invents the Model T.
Right.
You know, but but it's rare that it's bad for everything and bad for everybody. And what's bad for stocks as a whole is generally okay for bonds, and that's again why we diversify
Right.
like that.
And
So
then normally in the long term, things kind of equalize, and
right, yeah,
everything kind of goes up from that
yeah,
point. So,
yeah. A simple game you can play. You sound like a child doing it, but just keep asking yourself, and then what?
right.
Okay.
Yeah.
Unemployment went down 1/10%. And then what? Well, it may keep going down. And then what? Well, then the Federal Reserve will lower interest rates. Well, and then
Right.
what? Well, eventually you get
Mm-hmm.
to a point where things begin to stabilize and come back up, and you realize that it's not the catastrophe that it might sound like.
Yeah, absolutely. What else we got on our list of things to do here, Dave?
Well, there's always the next step after decatastrophizing and reality testing is problem solving, right?
Mm-hmm.
So, okay, you're faced with this problem. So, first of all, focus on what you can control, and in a macro sense, you can control your spending, you control your savings, and you control how your portfolio is set up in the first
Right.
place. So maybe don't make changes to your portfolio in the moment. But
Yeah.
if you're finding you're in a situation where things like what's happened over the last couple of weeks are really going to keep you up at night, then the next time things cycle to the better side, that's the time to make changes. And just
Right.
remember what this feels like, and that what you really want is not to be in this position again. Right.
Right.
So talk to your advisor, talk to somebody about how you can then lower the risk at the right time.
Right.
So, problem solving, part of that is making a plan for what to do when things are better.
Yeah, and I love that part about talking to your advisor. I feel like clients sometimes, don't reach out to us when they're worried, and
Right.
things kind of bubble up to the point where they have so much emotion or so worried about it
Yeah.
that they're almost, you go too far off the ledge, and then we
Well,
have to kind of make decisions, right? That we
right.
won't
Well, and
necessarily want to.
and as an advisor, just to put this out there, our problem is half the time for half of our clients, we're pointing out that, we're answering a need that they want us to address when we point out, hey, Monday was bad, but this
Right.
is the reality of it. But then for half our clients, it's like, oh, things are bad.
Right.
like, are we better off just not talking about it because we're playing the role of the press that we're telling people to ignore.
Right.
And even and just knowing that even if we're saying things really aren't that bad, the fact that we're pointing out that things
Yeah.
may not be great is not
Right. We don't
not
want to cause
right.
unnecessary worry.
Right. So to Nick's point, to your point, Nick, if you're feeling that way, talk to your advisor. If you're feeling that way, talk to your advisor, reach out and let
Yeah.
them know, hey, I need you to talk me off the ledge.
Right.
Or, I'm one of those people that is paying attention to the news and I need some help.
Yeah, for sure. And if
Yeah.
you're a do-it-yourselfer, like, I don't know. Well, so I put it this way, right? You and I obviously have a lot of experience in this stuff, but I still enjoy talking to you about certain things because
Hmm.
sometimes my emotions get a little bit higher than what they should, or like I need, reconfirmation that I'm thinking about things the right way. So, if
Right.
you are a do-it-yourselfer, either find an advisor or find somebody that you know that can help you have those
Y-
conversations.
Yeah, thinking back, not this last couple of weeks, but during 2022, I got a few emails from longtime clients that were of the they can be summarized as, I know you're probably going to tell me the same thing you've always told me over the last 15 years, but let's have that
Right.
conversation again. Tell me
Yeah.
tell me again why, why I'm okay.
Yeah.
And that's fine. That's
Yeah.
good. That's a big part of what we're here for. And to do that reality testing and to look at your
Right.
plan and make sure that it hasn't gone off the rails.
Yeah.
Um, I also like the idea of compartmentalizing risk mentally,
Mm-hmm.
and remembering, in terms of problem solving, you really should have a safe bucket for short term spending needs and a risky
Yep.
bucket for long term goals. And don't
Yeah.
confuse the two. And if you're finding that you don't have enough safe assets during times like this,
Mm-hmm.
you need to address that through saving more, but not usually through selling risky
Right.
investments in the face of a bad day or a bad
Yeah, I
month.
love that, especially for retirees, because it
Hmm.
gives you that, like you said, the compartmentalizing, which when you're young and you think about your long term retirement stuff, like that's the compartmentalization of, I don't need this money for 20 years. I don't really care
Yeah.
what happens, right? I do,
Yeah.
but in the short run, I'm not as worried about it. And
Right.
that you can kind of recreate that in retirement by having a safe bucket of more than enough for a year or two of spending, or three, depending on what level
Your
of
outlook. Yeah.
conservative or how you feel about things and how changes in the market affect you. And then you can kind of have that same thing of, well, yeah, my long term stuff's going down, but I got all this
Yeah.
money over here to get me through to the next point when things get better, right? And that is
Right.
super helpful for a lot of people, especially people that get overly anxious about changes in the market and things like that.
Exactly. Exactly. And so that kind of leaves us with the last point on the list, which I kind of consider like mastery. This is when
Yeah,
you've got control of your emotional state. You've taken control and blinked out again.
you cut out
Uh,
at "you've got control."
this is kind of where you've got control and you can now proactively do things during market crises that will be advantage to you later. And
Right.
generally, what they say, buy low, sell high, right? So, the first thing that comes to mind obviously is that's usually about the time the markets feel the worst is the best time to buy stuff,
Right.
and it's going to feel lousy emotionally maybe, but that's like a true sign of mastery of those
Yeah.
emotions that, hey, I know this, I maybe I'm throwing this money away, it may feel really bad, but that's probably going to pay off 2 or 3 years down the road. We've got some great stuff on that on our blog that Ashley and Michaela put together for us a couple of years ago about how our 401k contributions during the financial crisis played out and what the return on those assets have been.
Yeah.
And just remember that.
Yeah, it's definitely like you said, mastery. And one of the things that
Hmm.
I always think about too, because it it is somewhat like a market timing. I
Hmm.
just read the
Yeah.
headline. We'll probably put this into our running list of things that we talk about. But somebody was talking about how Warren Buffett was, the biggest market timer of them all, right?
Yes.
Because he's,
Well.
stockpiling cash right now while things are high and waiting for things to go down to buy, right?
Yep.
But one of the things about that is, like, don't worry so much about necessarily getting it perfectly right. Like,
Hmm.
you don't have to wait till the exact bottom, but if you do have extra things, or if you
Well.
do have things you're going to do, you can, maybe you want to make a Roth contribution, but you were going to wait a little while, but you have the cash. Maybe now's the time to do that because the
Yes.
market's down a little bit. Just
Yeah.
like little things like that that can make a difference.
Yeah. Yeah. And not to take anything away from Warren Buffett's acumen as an investor, but back to your point earlier about what game are you playing? Well,
Yeah.
Warren Buffett can sit on cash on the sidelines and wait because he's also got billions of dollars already invested too.
Yeah, exactly.
He's market timing around the edges of what he's
Uh-huh.
doing. He's not
Right.
like moving in and out, and he didn't move all of Berkshire Hathaway's assets to cash because he felt
Right.
like now's the So just
Yeah.
remember, even the great Warren Buffett, while you can take a lot of wisdom away from what he does, it's not necessarily the same game you and I are playing.
Yeah, well, and that's a perfect example of it too, right? Because there'll be, pieces in that article about how he has how many billions of dollars in
Right.
cash or whatever it is, and you're like, okay, but that's like 2% of his overall,
Yeah.
like the
Yeah.
value of the company or whatever.
Yeah.
So it's just
And
another one of those situations where it's not always as it seems, and and also he's playing a very different game than any of us, and different game than really anyone is playing, and so
right.
it would
Right.
not model your retirement investing after what he's doing at Berkshire Hathaway for
Exactly.
sure.
Exactly. Part of what springs to mind too is so this year, I don't think this affects our clients so much, but there's been some fear of missing out, right?
Oh, for
We've
sure.
seen tech stocks just take off, and people kind of feeling like they were left in the lurch and left behind. And I'm not again advocating this per se, but one thought is, now some of those things are less expensive. If you've had things on your list that you wanted to be invested in and felt had gotten away from you, start looking at, like, what price would you buy certain things?
Sure.
What valuation would you buy? I don't want to advocate for picking individual stocks. We've talked about that, but you know, just that idea of, hey, I felt like the market was getting away from me. Now it's come back down a little bit.
Right. Yeah,
So
for sure.
so have that strategy ready when you see times like this.
Yeah.
Some other stuff, Roth conversions always make more sense when the market's down than when the market's up, because you get the recovery in the Roth after you've paid the tax. So,
Yep.
with clients, we tend to do Roth conversions later in the year, but I always tell them, hey, if we get a major market interruption in the middle of the year, we might speed that timeline up a little bit.
For sure.
It's pretty rare, but it could happen. And tax loss harvesting,
Yep.
it's a good time to evaluate the long-term prospects of what you hold, and make
Hmm.
sure that everything you have is the way you want it, because you may be able to make those adjustments with less tax impact when markets are down.
Right. For sure.
Yeah.
This is all good stuff, Dave. To our listeners, if you have any questions or comments or tips that you personally live by when getting through volatile times in the market, we'd love to hear them at info@srbadvisors.com. Also, make sure you check out the show notes. We're going to have a link to our volatility survival guide in there, and we'll also put a link into some of the blog posts and the books that Dave was talking about as well. So make sure to check that out. And as always, Dave, it has been a pleasure.
It's been fun, Nick. I'll talk to you later.
This is a Zedia Media production.